Hi there, and welcome to our brand new video series where we take a look at the biggest events over the week ahead and give you some insight into how the financial markets might react. I'll be joined each week by trader and educator Chris Tubby from Symax Fintech. Hi, Chris. Nice to have you back.
Yeah, hi. Thanks, Michael. Yeah, it's really a pleasure to be back and really looking forward to doing these on a more regular basis.
Now, let's get straight down to it. Data suggests inflation seems to be coming down. Have you got any thoughts, any ideas on what investors might want to be looking at the moment?
Yeah, I mean, yeah, inflation is coming down, but it's coming down so slowly. It's certainly not racing down. And, a point here, and I've made this before, is that, this target rate of 2% is so hard to achieve for central banks at the moment. And to actually achieve that, they've got to have a consistent period of month on month rates at 0.17% interest, just an increase rather just in, the inflation rates. And of course, that's going to be so difficult for them to get to because that when you're looking at that, we've still got 5%. I mean, if you look in the UK, the expectations was it was going to dip below 10%, but it's not. It's still 10.1. So we've still got double digit inflation, and in the UK, it just seems that it's I'm old. So when I look back at sort of times when it's done this before, it has been a real battle to get inflation down in the UK. And in general, I mean, even the US to that degree. I think in Europe it might be a little bit easier. And that's down really to sort of how people manage their money, whether they're borrowing or whether they've actually got the cash. Now, with inflation, I think that the problem we've got at the moment is that the companies are really sort of increasing their profit margins. And when you look, I mean, container prices are lower, commodity prices are lower. Okay, they're not as low as they were pre everything, but they're still a lot lower than they have been. Energy prices, gasoline prices, and such like. But the one that really sort of sticks out for me are food prices still. And, I go on about this a lot, but I think with good cause is that for me, when you know that commodity prices have dropped down in the way of, the raw materials, that you go into supermarkets, everything's still at sort of pretty much record highs, certainly for the last 10, 20 years.
Well, we were talking before off air about inflation linked bonds, and you were sort of talking about this might be the time to start reconsidering those. What's your thoughts on that?
Well, you see, with the inflation-linked bonds, I mean, they're sort of it depends which country you're into, how they're sort of balanced, but they're very much based on an average of where inflation is. Well, that has been pretty good over the last sort of 6 to 14 months. But now the inflation's starting to come down, the return that you're going to get on those bonds is going to start to reduce. So for me, if you've still got any of those, it's time to consider moving out of them and getting into the more traditional bonds where you're getting that fixed term, that fixed return for however many years you want to commit your money for.
Oh, that's interesting. Well, I mean, if inflation does continue to slowly come down, are we likely to see many more interest rate hikes from the US and the European central banks?
Well, I think the Fed's got at least one or two more coming. When you hear the different speakers, I think now it's quite good because you're getting sort of a more mixed view from the decision makers on those committees, rather than all of them speaking with the same voice as they were about rates have to go higher, they have to go higher, and our rates high, they're higher than they've been for decades, but it doesn't mean they're higher. They're still only sort of 5%. If you look at it, the Fed funds are sort of 4.75, 5% at the moment. So they may get to about 5.25. Bank of England, we've got 4.25%. There may be one or two more rate rises there just because inflation is still so sticky. And then for the ECB, they keep warning that there's more to come, and they're only at 3% at the moment. So it depends how aggressive they are. There's, talk of maybe a quarter or possibly even a half on the next one. But so that I think that they may get to around about sort of 3.75%, possibly even 4%.
So, what should investors be looking out for then, if there are still some rate hikes to come?
Well, then it's just really sort of trying to lock in for the longer term. None of us know where rates are going to be in 1, 3, 5 years time. And even if you look at this year, there's still such a mixed consensus of where they're going to be by the end of this year. Some people are saying, "Oh, well, rates have got to come down," because there's more and more sort of talk about recessions as well. So as that increases, everyone is expecting that the central banks are going to suddenly reverse policy and start cutting rates. But in my mind, they're wrong. We're seeing those rates up there, and they're up there for a reason. And this inflation has really scared the central banks. So as I say, I believe that they're going to want to see 3 to 6 months of that sort of nominal 2% inflation rate before they would even consider what to do next in the way of policy, whether they should cut. But I think also that the fact that inflation has crept up so much, we've got to bear in mind that a lot of this inflation has come from supply chain issues rather than demand. But there is still strong demand. And again, a lot of that demand came from sort of the stimulus that was put in by the central banks and the governments in the first place after COVID. But I think that those rates are they're going to peak by the summer for sure. Again, just remember, this is just my view. And then so if they're sort of coming towards a close, if you don't need your money for a period of time, then that's when I think it's more interesting to look at some of these sort of fixed income bonds where you can put your money away for 3, 5, 10, 20 years, 30 years if you really want to. Again, just make sure you're not going to need that money because of the penalties of taking it out early. But otherwise, you can just leave it in there.
And get some great rates, I presume.
Well, at least you're guaranteed that rate for the whole duration of the bond. Yeah. Whether it's 1 year, 5 years, or 30 years. And who knows? Next year rates could be 1%. Next year they could be 7% at some stage. It really depends on what's going to happen with the economy.
Yeah.
And of course that at the moment is constantly changing.
Yeah.
And I think we're going to see another potential spike in commodities, possibly more on the grain side, because the Black Sea Agreement that was set up between Russia, Ukraine, and Europe is coming to an end on May the 18th. So that corridor of where the boats were allowed to go out is closing. Mm. Now, what that's going to do to grain and fertilizer prices, I don't really know. Oil prices have been coming down even after OPEC's cutting supply by over 1 million barrels a day, which pushed WT up to sort of over $83, which broke it out of that 72, 82 range. But it didn't feel comfortable up there. And this week it's been back down below 76, 77. So they're struggling there. And of course, part of that is the expectations that demand is going to sort of not necessarily remain so strong going forward.
I think plenty of headaches still for the central banks.
Yeah, absolutely. And I think really they need to cause recessions to get control of inflation again. As nasty as it sounds, they can reset an economy and build it back up much easier than they can get control of inflation because it's more driven from the supply side.
Yeah. Well, I mean, that's we've talked about the US and the European banks. Obviously, the big one for next week, got Japan. So it's Ueda's first Bank of Japan meeting. How do you see that going?
Well, yeah. So, again, I've been saying for a little while that now we've got this new governor. Uh, he's saying he's not going to change policy for the moment, but I think he's going to have to. Whether he's done it by the summer this year or it's going to take a bit later into the year, I'm not sure. But Japan's seeing their inflation at the highest sort of level since 1981. And of course, this week we've got CPI out, industrial production and retail sales in Japan. So it's going to be interesting to see what that data holds for them. Rate decision wise, probably a hold, but I just think they've got to at least move it back up to par and then perhaps even a slight positive rate sometime this year.
Do you see Japanese equities as being something to look at, sort of in the medium term?
Yeah, I do actually. It's such a sort of stable, and again, they've had a weak currency, so it makes it cheaper to invest there.
Great. Is there any other data we should be looking out for next week that springs to mind?
Yeah, I mean, there's a lot of US data out next week for sure. I mean, there's not much in the way of Europe, but in the US, I mean, we've got consumer confidence, which I think is so underrated as data. We account for 60 to 70% of an economy, so our spending really matters. I think that's played down a little bit more than it should be. There's some housing data out. There's manufacturing, durable goods are out. So they're the bigger ticket costs. So when people are spending on those, it shows that they've got that little bit more confidence. They might be changing their kitchen around and stuff like that. They've generally got a lifespan of at least 3 years. Now, jobless claims, obviously, that comes out every Thursday. And if you've noticed, and I've been warning about this, that number's starting to creep higher. And I think that's going to continue to move higher. And then on top of that, in the US, you've got GDP, and then the big one that comes out Friday, which is PCE.
Right.
So personal consumption expenditures. That is the real sort of inflation metric that the Fed likes to use, certainly Powell. And then on top of that, we've got Michigan Consumer Sentiment, Chicago Purchasing Managers Index. So there's loads and loads coming out there. In the EU, not so much. I mean, again, consumer confidence, GDP. Germany's got IFO out, which is always a good one to watch for. That's their business climate and sort of what the expectations are. And they're also GDP and CPI.
Okay, but I guess in terms of the equity markets, particularly for the UK and much of Europe, it's looking across the pond then at what's going on in the US, because we're always impacted by what's going on over there.
Yeah, I must admit this week I've certainly been trading more Nasdaq than I usually trade, but it's just been sort of moving around so nicely. And for me, I sort of created in my head this range of where I expected it to sort of get sort of a bit too expensive and also a little bit too cheap. And it's been hitting both those levels this week a few times. So yeah, it's been really good. Gold's been a bit more challenging, I would say, for a lot of investors because it's broken back down through the $2,000. Oil, as I said earlier, is sort of holding. But to be honest, I still think stocks are a bit overvalued. I mean, maybe earnings wise, profit margin wise, there is a little bit more sort of traction with them. But I'm not sure that that's going to be able. They're going to be able to maintain that throughout the year. As the potential for the recession becomes greater and greater, they're going to have to start cutting costs and just trimming their profit margins.
Well, I guess it will be interesting because we're hitting US earnings season, aren't we? So we're going to get quite a nice view of equities and their performance over the next few weeks. Tesla's been one of the big headlines, and we've seen shares fall quite sharply this week. What are your thoughts?
Yeah, so Musk's had a bad week, really. I mean, his rocket blowing up first of all, and then of course with Tesla, they've cut costs. Well, they've cut prices rather, but their costs haven't. Uh, they're one of those companies that sort of got some loans and borrowing there, so they're paying much higher. So that's really sort of squeezing their profit margins, I would say. At one stage, I don't know what it's ended up this week, but Tesla was down sort of 56 billion.
It's huge. I mean, we've been I think we've been a little bit cautious on Tesla for a while, actually, with our commentary as well. Chris, that's brilliant. Thank you very much for the insight. Just for the viewers, we'll be publishing. Well, Chris is going to be working on a more in-depth macroeconomic look ahead. And we'll pop a link in the comments below once that's available over the weekend. I think that's usually on a Sunday, isn't it, that comes out?
It is, yes.
So we'll pop that in once it's available. And thank you everybody for watching, and thanks for joining me, Chris.
Yep, no, it's been my pleasure. Look forward to next week.
Thanks.